Hey, what's up everybody? It's your mortgage expert, Brian McCauley here. So you're looking to buy a house in Dallas, Texas, and you're worried about these interest rates, but all you're hearing about is these interest rate buydowns. 3-2-1 buydown, 2-1 buydown, 1-0 buydown, temporary buydown, permanent buydown, and you're wondering, what does it all mean? Stick around. In this video, I'm gonna unpack it all and show you everything you need to know. So listen, as the housing market continues to heat up, buyers are having some concerns with limited inventory, but they still have the same concern that they did a few months ago, which is higher interest rates. Now, one thing about higher interest rates that we all know, they're not here to stay. But if you're the type of person that doesn't want to wait 6 to 12 months for interest rates to come down, you can actually get access to a lower interest rate today than what the market offers. These interest rates that are lower than what the market offers are called discounted interest rates. And the way to get them is you pay points, you pay fees. This is terminology in my industry that people use when they talk about getting a lower rate. So as a buyer, I don't recommend getting a lower interest rate when you have to pay the fees and the discount points yourself. But I do recommend if you're a buyer out there and you find a property where the seller will give you some closing costs, give you a concession, give you a closing cost credit, you use that money to buy down the interest rates. The reason behind this is getting a lower interest rate is much more advantageous to you as the consumer than taking the concession off the price of the house. I've got some statistics and some numbers that I want to show you on a side-by-side comparison as to why buying the interest rate down is much better and much more effective for you, the consumer, and will save you a lot more money short-term and long-term. So let's use a $500,000 house, for example. If you were to make an offer on that house, $500,000, and let's say you wanted to take $5,000 off the price, but you had to get the natural interest rate of 6.5% today, your payment would be $31.28. So taking that money off the price of the house doesn't do a whole lot to the payment. Now, if you take that same $5,000 and you offer $500,000 for the house, but as opposed to taking it off the price, and you use that $5,000 for an interest rate buy down for 1 year, moving it from 6.5 to 5.5, that's going to save you $238 in the payment. So one of them saves you a little bit of money, the other one saves you a lot of money. It's the same concept for the seller, which is you're asking for $5,000 off the deal, but one's off the price of the house, doesn't save you a whole lot of money in the payment, still got to pay the higher rate. The other one is obviously paying full price for the house, but using that $5,000 credit to do a 1-year buy down, which obviously buys the interest rate down for 1% for the first 12 months, and it saves you $238. It's a much bigger gain for you as a buyer if you go that route. To go even deeper on this, what if you had that same $500,000 property, but you wanted to get $10,000 off the price of the house? So $10,000 off the price of the house does the exact same thing, nothing for the payment. But if you were to take that $10,000 and give them full price offer at $500,000, but you use that $10,000 to do a 2-1 buy down, it would save you $534. So the difference of a 2-1 buy down versus a 1-0 buy down is, instead of it being 1% lower for 1 year, it's 2% lower for the first year and then 1% lower for the second year. It's a 2-year deal, but that $10,000 saves you $533 for year 1, and of course you'll be back to the initial savings on year 2. So in this example, you can see $10,000 off the price of the house doesn't do anything. $10,000 to do a 2-1 buy down saves you over $500 on year 1 and over $250 on year 2. And listen, to take it a step further, you can do a 3-2-1 buy down. That's a 3-year interest rate buy down. So same concept, except $10,000 off the price of the house. Let's do $15,000 off the price of the house. Again, saves you about $70 in the payment if you do it that way. But if you do a 3-2-1 buy down, what that means is year 1, the interest rate is 3% lower than the market rate. So if the market rate was 6.5, your first year, your payment would be 3.5%. That saves you $833 a month for the first year. And in the second year, it's back to 2% lower, which saves you over $550 on year 2. And then of course, back to year 1 on the third year, which saves you over $250. And so you can see right now, as a buyer, while there's still inventory out there, the rate buy down is the way to go, because really it's about affordability. It's about the monthly payment. And in a market that still has an opportunity for buyers to capture a house and capture concessions, I wanted to show you some side-by-side comparisons on why taking the concession off the price of the house doesn't move the needle a whole lot on the payment. but depending upon the concession that you can get from the seller, it can help you a ton, whether it be a 1-year buy down, whether it be a 2-year buy down, whether it be a 3-year buy down. It can move the needle on the payment, $200, $550, or even $833 for the first year on a 3-2-1 buy down. So just for some context, on a $500,000 deal, it cost about $5,000 to get the interest rate down 1%. It cost about $10,000 to get the interest rate down 2%. And it cost about $15,000 to get the interest rate down 3% on the 3-2-1 buy down. Regardless of which one you choose, it saves you a ton of money versus taking off the price of the house. Now, last thing I want to talk about a temporary interest rate buy down. It is temporary, so depending upon which product you choose, it won't stay there forever. It stays there short term, either 1 year, 2 year, or 3 years, depending upon which buy down product you choose. But here's the cool thing. A lot of people say, well, Brian, what happens if I do a 2-1 buy down or a 3-2-1 buy down? It costs me 10 grand or 15 grand and interest rates plummet next year, and I want to refinance my home loan into a 30-year fixed mortgage somewhere in the high 4s or the low 5s. So here's the cool thing about a temporary buy down. If you were to get a 3-2-1 buy down at $15,000 and you were good and set lower than a natural rate for 3 years, and let's say in 12 months the market bottoms out, people start to refinance, and you decide, I want to go ahead and refinance, secure a low interest rate for 30 years, so it's fixed and I don't have to worry about this again. What happens to that money? Is it in vain? No. That's the wonderful thing about a temporary buy down versus a permanent buy down. Any unused money that you don't disperse to buy that interest rate down for year 2 or year 3, whatever it ends up being, that gets fully refunded back to you as the client. So if you've got a 3-2-1 buy down, that's a 36-month buy down. Let's say you refinance permanently on month 17 and you've got the remaining amount of that money sitting in escrow for the buy down, and you reset your mortgage loan and your mortgage term, whatever that leftover amount is, 5 grand, 7 grand, depending on where it is at that time, that fully gets refunded back to you. So you will literally get a check in the mail. So all that money is not in vain. So as a buyer and a consumer, doing the 3-2-1 buy down is a win-win. If rates don't come down as fast as we all want, you're fully protected for that short period of time. If they come down faster, where we all think they'll come down in 2024, then whichever unused money out of that escrow and that buy down that hasn't been used, you get a full refund. So listen, I hope you found this video useful. If you did, do me a favor, like, comment, subscribe, share it with somebody that you know that could benefit from this, that could potentially be a home buyer. And if you want to have a conversation around this market, getting pre-approved or just the future and the housing of DFW, do me a favor, call us, email us, text us. No matter what, we're always here for you. Until next time, stay tuned.